All right. Hi, everybody. It's Mondays. We're going to go over Megan's Monday market update. We've got Matt Stancato here with Guild Mortgage Lending, and he's going to be giving us a rundown of where we're at in the market right now. And then we're going to dive into some more details around PFHA financing. So, Matt, tell me something I don't already know in the market.
Right now, we had some information come out around the CPI and inflation, and it had no effect whatsoever on the direction of rates. It was very interesting. So last week we had a CPI number that came out as expected, and coming out as expected usually will support the current direction of rates. That'll give it a little boost downward if it's headed downward. In this case, nothing happened at all, and that's interesting because what it says is that we are now receiving information that's already been incorporated into the system. So we already believed all these things to be true. And this confirmation that we received from the direction of inflation last week is showing us that what we're doing is already on the right track and doesn't need a lot of adjustment one way or the other. In response to that, we got a lot more hawkish talk from the Fed about maybe doing 2 cuts later in the year versus the 4 they were talking about last year. So when things come out and nothing happens, sometimes that means something too.
Interesting. Interesting. So, reconfirming what their suspicions already were with the CPI. And now, what do you think would happen if they decided to take a rate cut, let's say March or April?
Well, when you think about that, you have to think about if the Fed decides to cut rates, they cut their own rate. That's the rate at which banks lend each other money. That just means money is out there easier on the streets. You have to think about the second order effects of that. Money's out there easier on the street. You're going to have more of it to lend. If there's more of something, then the price of it goes down. Interest rates then begin to fall. So what's interesting is that we can look at something like the mortgage-backed security or the 10-year bond value. And even though we're looking for the MBS to go up and the bond value to go down, we can use those as tools to see where rates are going and why they're going that way. The MBS going up is probably our best indicator of what's going to happen with rates. And remember what any of these are. The value of NVIDIA is just all the information everybody in the world has about NVIDIA brought together in a single number, right? And when DeepSeek comes out and they're not using NVIDIA chips, then all of a sudden all that information changes and people don't think NVIDIA is worth as much anymore. You might differ from me in how much you think NVIDIA is worth, and I might differ from you. But long story short, all the information I know and all the information you know goes into a pot. And that pot produces whatever value you're looking at. That includes mortgage-backed securities. So when you have things headed a certain direction and then a cut happens and no great earth-shaking rate changes happen along with it, that means that it was what we were expected to do when we were expected to do it, and things are going to continue in the stochastic direction they're currently moving.
Gotcha. That makes sense. I was just thinking from the perspective of somebody who has maybe been waiting the sidelines to make a home purchase, maybe get a loan. If there were to be a cut come in the spring season and interest rates were to take a slight reduction, how that would stimulate the spring and summer market, because we have seen a lot of up and downs the last few years. So do you think that it would be kind of inflationary, that we would have too much going on? Do we find ourselves maybe paying more for houses, do you think? Or do you think that things have evened out enough now where it's a bit more balanced, even with the cut?
I mean, that's an excellent question. At this point, I believe that we're on a long, like I said, a long, slow slide down. That rate cut that we're going to see, and I don't think we see it till June, but when we see it then, I think that more than likely it confirms the direction that we're currently heading and that it doesn't cause any great shake in the market. I do think that we're probably going to get a normal benefit. So if they cut a quarter, we'll cut a quarter or 3/8 or whatever. But we're not going to see what we saw in October, which was all of a sudden we were talking cuts again when we hadn't been before. That was new information in the market, and that caused an earth-shaking, change in the rates. Volatility is often linked to how surprising the information is that we are finding out. So I don't think that rates coming down as I expect them to this summer are going to cause any significant change in the availability of homes. Because remember, we're already sort of at the bare minimum of availability of inventory, right? And that means that prices are pushed about as high as they're going to be pushed So rather than appreciation, rather than an inflation of prices, I think we're going to see things follow along the path they're currently on if that happens.
Yeah, I would agree. I'm pretty optimistic about it, mostly because I'm seeing things sitting longer, price reductions, like I've kind of said before, home inspections, things like this coming up. And even though we'd be coming into a market where people tend to get excited and want to make a move on something, I don't foresee this massive hike happening where people are overpaying $50,000 for their homes again. Knock on wood. My hope is that when we're kind of following this gradual decline in interest rates and things, that we'll continue to level out a little bit more and make it a what I would consider a more fair market for the buyer and the seller.
There's
So,
also, oh, go ahead, sorry.
nope, that was it.
There's also the consideration of what's going on psychologically with people. For the first period of time after rates go up, after a long period of them being down, there's a certain declination in general market activity, only because people are used to doing things at 3%. Now things are at 7%, and no one wants to do them. At a certain point, and I'm not sure exactly when it is, and there are lots of studies on this that are interesting. At a certain point, the mind of the consumer resets
Oh,
and
yeah.
begin to live in a world where rates are 7% instead of living in a world where rates should be 3% but are 7%.
Absolutely, absolutely. Because I know from experience when rates were going up to 5%, I was a little bit kicking and screaming about it. Like, I hope it doesn't go higher than 5%. You know, I'm so used to this 2.5, 3%. And any seasoned realtor or mortgage lender who's been around a while is well aware that we've had double-digit interest rates and things just so today would feel very abnormal unless you're somebody who bought a house during that season of time. So agreed. After about a year or two, I'm like, that 5% looks pretty good right now, actually. I would like that again. So agreed. There's just this reset mentally where you're like, yeah.
We find that there was a study I read on it. It's fascinating because somebody spent a lot of money to like send a scientist to be like, so how about today? Is $5 milk all right? Like at a certain point, people were like, yeah, it's fine, whatever. And
Yeah, like the new normal.
right, exactly.
How long is that? I almost wonder if, you know, how people say, oh, it takes, 60 days to create a new habit or 90 days to create a new habit. I almost wonder, is it that? Is it, but it maybe not 90 days, maybe it's 3 months, 4 months, 6 months.
I forget what the psychological threshold is. Like, okay, prices are this now, but I think
I,
it's that, and of course, that doesn't mean that a consumer just has to accept it. What the good part about it is that sellers now who may have been holding out because they want to get an exceptionally low rate on their next loan might be more willing to put their homes on the market because they too are living in this new normal.
Absolutely. Yeah. There maybe that home buyer, that seller is sitting on equity in their home and they really want to make a move, but they've been hesitant because they don't want to pay too much in their next mortgage. And now maybe this creates an opportunity for them where they feel more comfortable with the interest rates and offsetting their current primary residence. So definitely agree with that. Heading into more of a topic around FHA or
Yeah,
FHA, little bit of a tongue twister there. Tell me more about this loan and how it differs from maybe conventional.
we get questions on PHFA all the time. It is our single most popular first-time homebuyer loan. PHFA is not a government loan, but it sounds that way. So PHFA is a private company that loans money to Pennsylvania first-time homebuyers, amongst other people, and they have their own guidelines, and they lend money that they borrow on bond from the state of Pennsylvania. What that means functionally is they're only for first-time homebuyers for the most part. They have special programs, and these special programs have special rates. Right now, for instance, the least expensive PHFA loan is the Keystone Home Loan Program, which is at 5.875% at 0 points. That's for everybody across the board. If you qualify, you get the same rate. That's how they work. So
Fantastic.
what PHFA offers is that lower rate as well as a more flexible credit profile, or they allow for a more flexible credit profile down to a 660 score. They have a reduced mortgage insurance that they have, specially negotiated mortgage insurance rates. They have that low rate, and they also offer what they call KFIT. And KFIT is a second mortgage program on which you do not have to make payments. So you can do as low as a 3% down payment for the Keystone Home Loan Program. And on the back of that, you can borrow another 5% for a total of 102% of the home value. And that 5% on the second mortgage does not have to have payments made on it, although you do have to pay it back when you sell.
I see. Okay, so there's a lot to unpack right there.
A lot
So
of, a
let's go
lot,
back. So you said, as low as 3% down in comparison to a standard FHA loan product, which is 3.5. I mean, I don't think there's any other loan product that allows you just to put 3% down. So that's arguably really great. Lower PMI.
Mhm.
All right.
And there was yes, and what was I going to say? You just reminded me of something else. Yes, you can put down more than 3% if you want to. However, if you want to use the down payment assistance help, that 5% on the back, you have to go with a 3% down payment, and you can't have too much money left over. Again, this is not for people who have more than $50,000 remaining in non-retirement accounts. At the end of the day, if you got too much money, they're saying, okay, we're going to give this to somebody else. But you are also running into it used to be you could do 100% financing programs anymore. 3% is the bare minimum that you could put down, and conveniently PHFA offers PHFA conventional and PHFA FHA flavors of their product. So if you want FHA financing with the FHA mortgage insurance and FHA requirements, you can go that way, and if you want to do a conventional version, you can go that way as well.
Okay, so the 5% that you'd be getting is required to go towards your closing costs, though, correct? Like it can't go towards anything else, repairs on the property. It has to specifically go to closing costs, or
Is a net 5% that goes towards you. That is a second mortgage that goes behind the first mortgage. It's up to 100%, 102% of the loan amount. Because it's over 100% of the loan amount, there's no dictating where that other 2% goes. It can go towards closing costs. If you have something on the closing cost sheet regarding a repair, it can be applied to that. It's all fungible. It's 5% going to you. You can use it for what you need it for.
see, that's fantastic, though. It gives you a lot of leverage when negotiating deals. And does this work the same for the conventional?
Yeah, the same way. You can do the second mortgage on the conventional side as well. The difference between them is that you have a lower credit requirement with PHFA, FHA, but the
Oh,
rate is higher. So 5.875 applies to the conventional flavor of PHFA. I think it's a little higher on the FHA side, but the FHA side allows credit scores under 660 all the way down to 600, whereas we wouldn't allow that on the conventional side.
all right. And now I know we had talked briefly about like bankruptcies before this and how that also can differ when you're going FHA, PFHA. I feel like I have to clarify versus the conventional product. Tell me about the time limits for somebody who maybe has a smudge or a bankruptcy on their credit report, but is rebuilding their credit and they're trying to get in the door and use one of these loans.
Sure. There are different periods after a bankruptcy, depending on what kind it is, a Chapter 7, a Chapter 11. We're not really concerned about business bankruptcies. Chapter 13s are kind of their own thing, and we're not truly concerned with them. But if it was a Chapter 7, there's either a 3 or 4 year, depending on what kind of program you get, waiting period between the day of the discharge of the bankruptcy and when you're allowed to make application on it, not make application, when you're allowed to close the new loan.
Mhm.
And actually, you know what? Let me think. It may be the date of application and it may be the date that you close. I would have to double check on that. I don't know off the top of my head. But anyway, there's 3 and 4 year waiting periods depending if it's FHA or if it's conventional. There's a briefer waiting period after a bankruptcy for an FHA loan than there is for a conventional loan. But in either case, the reestablishment of your credit is usually sufficient after that time, as long as you haven't made any other mistakes, in order to get you back to being mortgage ready. By the time most people have passed the waiting period, their credit is already to a numerical number where they're able to start looking at all these things again. Because remember something interesting about credit scoring, which is that you're not really being measured against every other person in the system. There are 10 credit scoring buckets, and you're being measured against people who are very similar to you. And the reason that makes a difference is if you have made all of your payments for your entire life, you have virtually no debt at all, you've been have 50 years worth of positive credit, and you make one bad payment, you're being compared to all the people who have perfect credit like you. You may have a lower score than somebody who got over a bankruptcy 12 months ago, but has reestablished positive credit because that person is being compared to all the other people with recent bankruptcies. That's why the numerical
Mm.
score in some cases can be misleading. You can have a 720 on your credit score, run it through the automated system, and the automated system says, hey, you had a bankruptcy 3 years ago. You haven't reestablished enough credit yet, even though you have this high numerical score. Not a lot of people know that, and it's one of the reasons why it's good to talk to somebody, even if you are keeping a good eye on your credit.
Absolutely. I mean, I can't say it enough. Planning is so important. And when it comes to buying a home, it's so important to plan for that and not just with the monetary money that you're trying to put into your account. It involves many other items. We're talking about where you want to live, the type of financing you can use with where you're trying to go. And it's a very unique process to the individual, as you just pointed out. You're looking at their individual credit, their individual history, their income, what they're trying to do, and you're trying to help them make the best decision, as I am too. Speaking about how to use these loans, I think there's some misconceptions around what this loan can be used for. Like, what types of properties can you purchase with this type of loan? Is this loan as sound or secure or appealing as maybe a conventional loan? I know for a fact that you can use this loan on single family homes, maybe even condominium units. Manufactured homes, I believe it has to be fixed, has to be
That's
considered a fixed single family home, can't be considered a mobile home, right?
it's on a permanent foundation. If it was assembled in place and we call that a modular, that's fine. If
Mhm.
it's a true trailer that has a chassis that can be moved, then we can't lend on that.
Got it. Yeah. And then can this loan be used in a small multifamily scenario as well?
Certainly, if you're living in the one side and renting out the other, as we talked about last week, yes, this would be another option for that as well. PHFA is actually rather flexible with the kind of property they'll accept. One of the most important things that we talked about last time, but I thought we should probably go into more detail about, was the reason that many people are reluctant to think about FHA financing. Uh,
Mhm.
you asked a very interesting question. Is it more secure? Is it more is it more desirable? And the answer is not really. In any case, you're going to have some sort of insurance policy on the loan if you have less than 20% down, right? So if
Yeah.
it's FHA, it's a government insured loan. If it's a conventional loan, it's a privately insured loan. PHFA has their own contracts with the PMI companies, so they offer that mortgage insurance for you. But in any case, you're going to be covered in some way. So to the end user, to you, to the investor, FHA is just as good as conventional. The reason most people don't use it is because they have it in their head, and for very good reason back in the day, that FHA was going to put you through the ringer, that it was going to be really hard. The appraiser is going to tell you to fix 1,000 things, and the seller is going to get mad, and the buyer is going to get mad. And that did used to happen. But it's been over a decade or two now where they've really loosened up the FHA guidelines to the point where the only thing they care about is safety on the home. They prefer to have people own homes than to turn them away from owning homes because of knob and tube wire. So it's become a much different environment than it used to be. And some agents who are not as up on the changes as others still have it in their head that I'm not going to accept an FHA offer, and it's very infrequently uh, a deal breaker these days.
Yes, yeah, absolutely. I think that when a consumer is sitting down and talking with their lender about their different loan options, if this loan product comes up as being very beneficial for you because you can get in the door with as little down as possible, you can afford the payment, maybe you're paying less in the PMI. I highly suggest that it's considered. Don't, think that you have to go with a conventional financing or you have to go with other traditional financing. This loan is fantastic and can still work wonderfully and benefit them fantastically. So,
And that's also what you were talking. I think something important that you mentioned before is that talk to me early, where we love to work with people for a year, 2 years before they buy. We tell them the best place to go. They follow the instructions. They get in the best possible position for themselves. And okay, I'll settle you in 30 days too. Don't get me wrong. But we do enjoy working with people and educating them and helping them find something over a long period of time. We don't mind if you're 6 months away. We'll happily pre-approve you and spend the time.
Now, another question I did have, more of a logistical question, is, you're talking about putting 3% down, getting that 5% essentially in assist, or, 100% financing in essence. What about gift funds? Let's say grandma is willing to help out, wants to give them funds towards anything. Hypothetically, if they wanted to, doesn't sound like they would need to with this loan product, but let's say that they wanted to, could they?
Yes. Gift funds are used on, I'd say almost 30% of the loans that we do. Very frequently do people get involved in gifting to, usually their sons and daughters for the first time to buy. So a couple things about that. Many people stay away from gifting because of tax implications, but although always proper caveat, consult your tax professional, blah, blah, blah. But we know that a gift that you give to a family member cannot be taxable until you reach a lifetime cap of, I think it's $5 million in total gifting. Very few people ever reach that. So the tax implications of gifting that scare a lot of people away really aren't a problem anymore. So that's an important thing to keep in mind. And yes, we can arrange a loan such that between the first mortgage, the second mortgage, a seller's assist, an additional grant, or a gift from a family member, you can get into your house for nothing out of your own pocket. It is absolutely possible. We've done it many times before.
Ding,
We
ding, 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 ding. Light bulbs going off for anybody listening.
and we found that if people are utilizing these programs properly, that they become homeowners, with equity and with equity position to move forward without having to have taken any of that out of their bank account short term. So we love this program.
Yeah, this is great. I love this too. And I'm glad that you hit all those little details and lined them up nicely that people really can get in the door with nothing down potentially. Now,
Mhm.
that is dependent upon, like you said, seller assist, the deal itself, different items. But
Transfer
um,
so where you are, it can be more or less. But if you're thinking in your head that I got to put away 50 grand before I can do this, then you're very, very off.
yes, yes, I definitely agree with that. Was that everything today? I don't.
I think that's it. That felt pretty good. I felt like we got a lot of them.
I feel like we were on point and we actually hit all of our talking points.
We can split this into two.
Yeah.
This is crazy. This had a lot of really good info in it. I like it.
I came prepared. That's what it was,
You did a good.
Well, thank you, Matt, so much for your time today going over all of those details. I would like to highlight that Guild Mortgage Lending is a national mortgage lending company. So even though Matt may not be in your local state or your local community, it doesn't mean you cannot reach out to him and we can't get you connected with somebody or even start the process. Get it over to somebody to help you with that. In the same aspect, I am a licensed realtor in PA, but I'd be happy to connect you with somebody in your local area, community, or state if it's not here. Again, thank you, Matt, for your time, and I hope everyone has a great week.
Happy to do it. I'll see you soon.